We just finished going through TSMC's 2026 second quarter earnings materials, and now we want to share our takeaways with everyone. Okay, I'm just off this one and honestly a little wired, so let me give you my verdict first, then double back to prove it. This is the single most important company in the entire AI trade. The toll gate everybody has to pay to cross, and I'm landing on a green light. Yeah, green, and I don't hand those out very often. But before you get too excited, there's a catch buried in the margins that you need to hear, because green does not mean risk-free. So let me walk you through the whole thing. So the deck sets its ambition right up front, and it's a big one. This isn't a recap of one quarter, it's a teardown of TSMC's entire blueprint out to 2030, and it tells you the 3 things it's going to weigh, so hold these in your head the whole way through. 1. Foundational growth. Is the AI demand real and durable, or just a spike? 2. Margin realities, and that word realities is doing a lot of work here, because the margins have a wrinkle we'll get to. 3. CapEx commitments, the frankly staggering amount of money they're pouring into new factories. Here's my read on why the framing matters. A lot of people look at TSMC and just see AI hype plus a great quarter. The deck is basically saying, slow down. The real story is whether the growth, the margins, and the spending all line up for the next 5 years. That's exactly the right question to ask, so let's actually answer it. Alright, first piece of evidence, and this is the part that got me wired. Management isn't nudging one lever, they've got 3 throttles pushed wide open at the same time, and that combination is the real tell. Throttle 1, revenue guidance. The company is guiding for over 40% full-year growth. That is enormous for a company this size. Throttle 2, CapEx, they revised their spending commitment up to $60 to $64 billion. They're not just forecasting the boom, they're funding it. And Throttle 3, the belief, they've stretched their AI cycle conviction all the way out to 2030. Now here's why all 3 at once matters, and it's the deck's point, and I agree with it. Anybody can have one blowout quarter, but you do not revise your 5-year spending up by tens of billions over a single quarter spike. When a company puts its own balance sheet on the line like that, it's telling you it genuinely believes the demand is durable. That's conviction you can measure in dollars, not just words. Now let me teach you why this company is different from almost anything else you own. Picture a stack with 3 layers. At the top, the architects, the famous fabless chip designers, brilliant companies that design AI chips but own 0 factories. At the bottom, the output. And the deck says 77% of TSMC's wafer revenue now comes from the advanced nodes. That's 7 nanometer and below, the true cutting edge. And in the middle, the foundation, TFC itself, which the company describes as the sole foundry actually capable of turning those complex AI designs into real silicon at high yield on time. Here's the line from the deck that says it all. In the AI wave, TSMC is the only toll gate operator collecting structural rents. Chew on that word, rents. It does not matter which chip designer wins, they all have to drive through TSMC's gate and pay the toll. That right there is the most durable position in the entire AI food chain. Okay, the actual scorecard, and let's separate what happened from what's merely promised. On the realized side, the quarter that's already in the bank, revenue landed at $40.2 billion, right at the top end of their guidance. And gross margin, get this, 67.7%, that beat guidance, and it's up 150 basis points from the prior quarter. Let me put that margin in plain terms. For every dollar of chips they sell, roughly 68 cents is gross profit. That's a software, like margin on the most complex manufacturing on earth. They credit cost improvements and slightly better factory utilization. Then the unrealized side, the outlook. Next quarter, they're guiding to $44.6 to $45.8 billion, a median jump of 12% in a single quarter, and up 37% from a year ago. And here's the nuance I want you to hold on to. The company admits the consumer end markets are actually soft, squeezed by the economy and pricing. It is the AI demand, and only the AI demand, carrying this entire thing. Keep that in mind because it comes back to bite later. Now here's where that AI dependence shows up in black and white, and it's genuinely stunning. High performance computing, which is basically AI and data center chips, is now 66% of TSMC's total revenue, and it grew 20% in just one quarter. 2/3 of this entire company, tied directly to the AI build-out. Meanwhile, look at the old workhorse smartphones, down to a 22% share and actually shrinking off 4% for the quarter. Automotive and the Internet of Things grew nicely, up 15 and up 4%, but the deck is honest that those are small volume bases. They don't really move the needle. So here's the picture, and I want you to sit with both sides of it. The bull says, fantastic, TSMC's growth is now perfectly since to the biggest spending wave in tech history. The bear says, sure, but two-thirds of your business now rises and falls on a handful of hyperscalers' AI budgets. Both of those are true at the same time, and that tension is the heart of this stock. Here's a slide I love because it answers the scariest question a chip investor can ask: what if I bet on the wrong architecture? The deck shows the new wave, agentic AI, feeding demand into 3 different chip families: the old x86, the ARM designs, and the up-and-coming Res-V. And interestingly, the company says this agentic AI wave is actually reviving demand for data center CPUs, not just the flashy accelerators. But here's the punchline, and it's beautiful in its simplicity. Look at where all 3 of those arrows point. They all end at the very same place: the TSMC fab. The deck's own words: regardless of who wins the architectural war, all the silicon is printed at TSMC. Think of it like a gold rush, and TSMC isn't betting on any single prospector. They're selling every one of them the shovels. That's my read on why they can commit to that massive capex with a straight face. They don't need to pick the winner. They just need the war to keep being fought. So let's talk about that spending, because the numbers are honestly hard to comprehend. Start with Arizona. The company is injecting an extra $100 billion there, roughly 265 billion Taiwan dollars, to build around 4 new fabs in the US. And that is on top of the domestic base, 13 advanced node and packaging fabs planned back home in Taiwan. Zoom out, and the global capex budget got revised up to $60 to $64 billion from a prior range down in the low 50s. And crucially, 70 to 80% of that is aimed strictly at the advanced nodes, the AI money makers. Now management gives 2 reasons, and the second one is clever. 1, unrelenting client demand. The customers are pushing them to build faster. And 2, inflation hedging. They'd rather buy the equipment now at today's price than pay more for it later. That second reason is a genuinely smart move, and it tells you they expect costs to keep climbing. But I'll be honest with you, spending this aggressively is also the single biggest risk here. If AI demand ever blinks, that's a whole lot of very expensive concrete. Now here's the timeline, and it's a 2-sided coin, so let me give you both faces. Phase 1, the demand today. Management flat out says the supply deficit for their most advanced chips, the sub-3 nanometer stuff, is, their words, very large. Not tight, not healthy, very large, meaning they can sell every single wafer they can make. And they're stretching that conviction all the way to 2029 and 2030, where they believe their tech becomes the new AI industry standard. But now phase 2, and I really respect that the deck put this in the reality check. Everything from 2026 out to 2030 is still an unrealized outlook. It has not happened yet. It's a forecast. And the deck adds a line I want to underline: client aggression necessitates analytical caution. In plain English, when your customers are this hungry and this loud, it's easy to get swept up and believe the far outnumbers. That's a remarkably honest thing for them to say, and it's exactly the discipline I try to bring. Believe the very large deficit today. Stay skeptical on the 2030 promises. This is the slide that, for me, seals the moat, so let's walk up the staircase. Step 1, the 2 nanometer node, they call it N2. It's scaling right now and already kicking in 3% of wafer revenue this quarter. Step 2, the AHO2 node trials in 2027, volume in 2028, and the specs are serious. 10 to 15% more speed at the same power, or 25 to 30% less power at the same speed, plus 20% more density. Step 3, the A13 and A12 nodes already targeted for 2029. Here's the strategic takeaway, and this is the whole ballgame. While their competitors are still struggling just to reach the 2 nanometer starting line, TSMC has already paved a continuous, locked-in roadmap all the way through 2029. Think about what that means for a customer. If you're designing chips for the rest of this decade, there's really only one road, and TSMC owns every mile of it. That's not a lead. That's a different race entirely. Okay, every great story has a choke point, and here's TSMC's. It's the packaging. The deck shows all this surging wafer demand slamming into a wall called CoWoS. That's the advanced packaging that stitches the AI chips together, and capacity there is constrained. The company admits it's actually limiting how fast clients can grow right now, so they're planning a 14 times expansion of that capacity, and pushing new tech like glass substrates about a year from maturity, and silicon photonics for lower power and higher bandwidth. But here's the judo move that's genuinely clever. When rivals offer their own competing back-end packaging, TSMC basically says, come on in, we welcome it. Why on earth would they do that? Because back-end capacity is so tight that if a rival handles some of the packaging, that just frees up more demand for TSMC's high-margin front-end wafers, the part they utterly dominate anyway. So they turn their one bottleneck into a way to funnel even more of the profitable business back to themselves. That's the confidence of a company that owns the only door that actually matters. Alright, this is the catch I promised you at the very top, so pay close attention here. Remember that gorgeous 67.7% margin. The deck walks you down a staircase showing why next quarter it dips to around 66%. First drag, the 2 nanometer ramp. Brand new nodes are expensive before they get efficient. That's a 3 to 4 point hit. Second drag, those overseas fabs, especially Arizona, cost more to run than Taiwan. Another 2 to 4 points, and that one scales up over time. Then they claw some of it back with cost improvements and pricing power, landing at a 66% midpoint. Now here's the analytical decode, and this is the key judgment call. Inventory days have stretched to 87, mostly from prepping for 2 nanometer. So is this margin slipping the start of real decay? The deck argues no, and I mostly agree. This dilution isn't the business rotting, it's the unavoidable tax of expanding this fast and going global. But I'll grade my conviction honestly. I'm maybe 75% that it's just a tax, so watching that 60% floor is job number 1. Now this slide is the most important reality check in the whole deck, so please don't skip past it. The company splits its world into 2 speeds. On one side, structural deficit, genuine shortages, and it's all the AI stuff, the accelerators, high performance computing, the power management chips, the advanced sensors, all driven by data centers screaming for power and compute. On the other side, macro suppression, and management flatly confirms these areas are absolutely not short. Consumer tech, the standard mature nodes, commodity chips, all soft. Here's the takeaway the deck lands on, and it is crucial. This is a surgical AI exclusive super cycle, not a broad-based recovery across the whole chip industry. And this is where the bear case gets its teeth, so let me steelman it fairly. If your entire boom is one narrow slice, AI data centers, then the day those hyperscalers trim their budgets, there's no broad consumer recovery underneath to catch you. TSMC is riding one incredibly powerful horse, and the honest risk is that it is mostly just the one horse. Let me play referee on what management said versus what they actually meant, because the gaps are revealing. First, on CapEx and Arizona, the signal was spending is way up. Arizona adds about 4 fabs. My decode, the direction is screaming bullish, but notice they withheld the precise numbers. And my read is that's deliberate. You keep your exact plans vague to hold negotiating leverage over customers and suppliers. Second, on packaging and competition, they said glass substrates mature in a year and rivals are welcome. The decode, that welcome comes from total front-end confidence. But they also refuse to break out packaging CapEx separately, which conveniently hides exactly how fast they're clearing that bottleneck. Third, on AI demand, they just kept repeating that the growth rate is stronger and stronger. Here's the tell, and it cuts slightly against them. They wouldn't give specific CPU versus GPU numbers, which says they're leaning on the overall wave rising rather than precisely forecasting which chip wins. None of this is dishonest. It's a monopoly choosing what to reveal. But knowing what they're not saying is half the job. Last slide, the deck hands you the exact dashboard to grade them by 6 gauges, so print these out. 1. Margin defense. Can they hold that 66% floor, or does the 2 nanometer dilution punch right through it? 2. Growth delivery. Does that slightly above 40% full year target actually jump higher or stall? 3. Capex execution. Is that 60 to 64 billion deployed efficiently, and where do they revise it next? 4. The Arizona timeline. Are the real milestones on that $100 billion? 4. Fab commitment that's actually being hit. 5. Tech scaling. How fast does 2 nanometer revenue climb? And does the A14 chip stay on schedule? And 6. Bottleneck clearance. How fast does that packaging capacity expand? And when do glass substrates truly hit volume? The deck's closing line nails it. The trajectory is historic, but the execution must be flawless. Flawless is a very high bar, so keep your eyes locked on these 6. Alright, last thing, radar always leaves you a light. I'm weighing everything. The toll gate monopoly nobody can bypass. The roadmap locked through 2029, the 40% plus growth, and a balance sheet spending $100 billion because demand is, in their words, very large against a real margin dilution, and a super cycle that leans almost entirely on AI data centers holding up. And I'm calling this one green. Green because unlike a lot of expensive AI names, this deck doesn't show me a business priced for miracles. It shows me the one company every AI chip has to pay with the deepest moat in tech and a roadmap no rival can touch. The fundamentals hold up, and it earns a real spot on the watch list. But here's exactly what flips me off green, and I'm telling you this up front. If that 66% margin floor breaks, or if the hyperscalers ever pull back on AI spending and that surgical super cycle loses its one horse, I drop straight to yellow, maybe lower. For now though, when you own the only gate and everyone has to pay the toll, I lean green and I'm comfortable saying it out loud. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.